All right, we've been looking, just been looking at results from J.P. Morgan and Wells Fargo, and we're awaiting Goldman Sachs and Citigroup. Joining us now, Stephanie Link, Chief Investment Strategist at Hightower Advisors and a CNBC contributor. You've owned some of these names in the past. Stephanie, give us a snapshot of, at this point in time, from what you know so far from who's reported.
Yeah, so far so good, right? So I think the big theme on the positive side for the quarter for all the big banks is going to be fee growth. And this is exactly what we saw from JP Morgan and Wells Fargo. Fees for investment banking and JP Morgan up 49%, Wells Fargo up 59%. These are huge numbers, Joe. And recall, last quarter, they also reported very good fees that surprised to the upside. So I think you're going to continue to see equity capital markets be something like anywhere from 40 to 60, maybe even 70%. I think Bank of America is going to post a 70% number. Investment banking, 30% on average, and then equity and fixed income trading in the mid-teens. So that will be the positive. I think also the positive is going to be M&A. Remember, last year we did $3.3 trillion in global M&A. Larry Fink just talked about it, right? So we are going to see a tailwind this year from the momentum last year, but it should improve under the Trump administration. By the way, it's January 15th, Joe, and we've already done $100 billion in global M&A. So those two will be real positives. I think loan growth is not going to be so great, maybe low single digits for the group on average. And then net interest income and net interest margins will certainly not be great, but we just got Wells Fargo raising the net interest income guide, which is what we're all expecting. And that's the real icing on the cake, because we haven't seen net interest income growth in a very long time. And that has something to do with the yield curve. By the way, Bank of New York Mellon reported net interest income that was better and net interest margins that were much better than expected. So the stocks are still cheap. Wait until we get Basel III Endgame, the capital rules, and it not being as restrictive. Then you're going to start to see buybacks as well. So I think these stocks are still a buy.
It's kind of weird, Stephanie. We understand how some of this stuff works with the stock market, like the banks and the Trump trade. So a lot of stocks moved, and the inauguration's not till January 20th. So we understand how stocks can move in advance of what they think are going to be some tailwinds. But why do the numbers already, the actual past 3 months, why do the numbers already seem to reflect better operating conditions?
Well, I think a lot of it has to do with, Joe, we're growing at about 3% in the economy. So there is a lot of underlying momentum in the economy that the Trump administration is inheriting. And I think that people and CEOs and the executive benches at a lot of these companies are starting to feel better. And on top of the activity already being strong. And these companies have done an amazing job in terms of expense control. So that's been the story for the last couple of years. It hasn't really been the top line so much as it's been the expense and kind of keeping things in order and in check until we could see better activity. And so I think that's really, at the end of the day, the economy is driving the activity, and we're going to see continuation of that under the Trump administration and his policies.
Well, maybe not just the continuation, but some of the other stuff. If they've gotten their, the expense line under control and in order, and then you do see M&A pick up and whatever other things that you think of with deregulation, Basel III, whatever you expect to happen, they could be totally leveraged, and this could be the beginning of even better numbers. Like the next quarter, you could even see better numbers.
100%. That's why I mentioned net interest income. That's the one area that I'm watching. And last quarter, we asked all of the CEOs, when are we going to see net interest income starting to increase? And most of them were pretty cautious and conservative. And so I think that's going to be a nice additional driver in 2025. We haven't seen that in a very long time. And to your exact point, if you have good expenses, solid margins, and now you get top line acceleration, that's operating leverage, right? That's the the definition. And that's when stocks really take off. And these stocks are still pretty cheap. Now, JP Morgan, it's a beast, right? I mean, but it's priced like that at 2.1 times book. But they are so good at what they do. However, some of these other banks are trading at 1.5 times book. And I think as ROTCE goes higher and then the operations go higher, fundamentals go higher, I think you can get maybe into the upper 1.7, 1.8 times book, which gives you a lot more upside. By the way, the regionals, like Truist, I own that one in full disclosure, but Regions as well. I mean, those stocks are trading below book value. So Citigroup, below book value. If they're buying back their stock at below book value, that's very accretive in addition.